in a share exchange. So financial data for the two companies are given below. The financial data for the two companies are given below. So they gave you sales, net earnings, ordinary shares outstanding, ordinary share market price per share. They have also given you dividend per share. Then additional information, note number 1. Chilulu Limited is not willing to incur an initial dilution in its earnings per share. Then Roma letter 2, Chilulu Limited will have to offer a minimum of 25% of Rockers Limited current share market price. So now required Roma letter 1, they wanted you to compute the relevant offer price range. The relevant offer price range. Roma letter 2, if Rocker Limited shareholders accept an offer by Chilulu Limited of shillings 40 per share in a share for share exchange, determine the post-merger earning per share. They would like you to get the post-merger earning per share. Then Roman letter 3, using the results obtained in C Roman letter 1 above, and assuming that Chilulu Limited price earning ratio will remain unchanged after the merger, they wanted you to determine the post-acquisition market price. So the concept will still be the same, the price earning ratio. You use it now to compute what is supposed to be the market price per share. So we go back to the Roman letter 1. How to compute the range. So to get the offer price range, you will use the note number 1. Note 1, you are calculating the non-diluting offer price because they don't expect to incur any initial what? Dilution in its earning per share. Then Roman letter 2 is another item where you get the minimum offer price. So to get that range, simply get the non-diluting offer price, you subtract the minimum offer price. That's now what should give us the offer price range. So we start with the note number 1, how to calculate non-diluting offer price. We need to come up with the non-diluting offer price. Non-diluting offer price. Non-diluting offer price. So to compute the non-diluting offer price, remember we said that it is given by the price earning ratio of the predator before their acquisition. Multiplied by earning per share of the target. Earning per share of the target also before their acquisition. So when you want to calculate the non-diluting offer price, you simply come up with the price earning ratio of the predator before the acquisition. You multiply by earning per share of the target also before the acquisition. Remember, when it comes to that particular portion, we are not given the earning per share. So the first thing we do is to calculate the earning per share. So to get the earning per share, first we need to come up with the earning per share. So earning per share is supposed to be given by earnings available. Earnings available divided by number of the ordinary shares. So to compute the earning per share, you simply take the earnings available divided by the number of the ordinary shares. So we start with the one for Chilulu Limited. So there was an argument there. They have talked about the ordinary share market price. Then you see the ordinary shares outstanding in millions. So there are 6 million, but remember up there, they had put it their shillings. You see that? So it will not apply to the number of the ordinary shares in millions. So those ones we just assume they are the number of the ordinary share. So just maybe by arrangement mistake where they were able to make it. Because if they could have given you the bar value per share, that's now when you could go and calculate the number of the ordinary shares. But now they just gave us ordinary shares outstanding in millions. Then they gave you ordinary share market price per share. So the issue there is that that one they should not have included it up there. The shillings in millions which are up there, they should not have been able to. They should have put for each one of them. So we assume it is not part of it because you are not given the bar value per share in order to get the number of the ordinary shares. So what we do for that, you start with the one for Chilolo Limited. You start with the one for Chilolo Limited. So Chilolo Limited earnings is the same as the net income, which is 30 millions divided by the number of the ordinary shares outstanding in millions, which is 6. So that should be able to give us how much? Give us 5. Then we do the same for Roca Limited. The one for Roca Limited, net earnings is 12 millions. You also divide by the number of the ordinary shares. The number of the ordinary shares outstanding are how many? There are 2 million. So when you do that, we end up getting 6. So once we have done that, we go back to the question to get the non-diluting offer price. We go back to calculate the non-diluting offer price. So to compute the non-diluting offer price, to calculate the non-diluting offer price, so price earning ratio, the price earning ratio of the predator before the acquisition. Remember, it is market price per share divided by earning per share. So remember the price earning ratio. So what is the market price per share for Chilolo? Ordinary share market price per share is 50. Then we divide by the earning per share to have just calculated. We got which figure? We got 5. Then what is the earning per share of the target? Earning per share we have just calculated for Roca. So multiplied by 6. So that should be able to give you us 6. To be able to give us a figure of 16. So now after that, we should also be able to see how to get the minimum offer price. We should now also come up with the minimum offer price. Minimum offer price. So to compute the minimum offer price, the minimum offer price, it is that Chilolo Limited will have to offer a minimum of what percent? 25% of Roca's Limited what? Current market price. So simply get 25%. 25% of the price per share for Roca. The market price per share for Roca is 40. So we come up with the value for that. So we give us 10. So now we can get the offer price range. We can now come up with the offer price range. So to get the offer price range, you simply take the non-diluting offer price then subtract the minimum offer price. You simply take the non-diluting offer price. Then you subtract the minimum offer price. So those are the two notes which are to be used to calculate the value for that. Compute the value for that portion. Compute the value for that element. Compute the value for that. So from there, we now go to the Roman letter 2. We go to the Roman letter 2, where we now compute from if Rockers Limited shareholders accept an offer by Chilulu. If they accept an offer by Chilulu Limited of 40 shillings per share in a share for share exchange. In a share for share exchange. So determine the post-merger earning per share. So this is now share for share exchange. You want to compute the earning per share. So first we calculate the exchange ratio. We need to come up with what is supposed to be the exchange ratio. Let us see how to compute the exchange ratio. So to compute the exchange ratio, calculate the exchange ratio, we simply take the offer price. We simply come up with the offer price, divide by market price per share of the predator. We divide by market price per share of the predator. The market price per share of the predator. So offer price has been given as how much? 40. They have offered you 40 shillings. But we divide by market price per share of the predator. The ordinary share market price for the predator, that is the one for children, we divide by 50. So that we come up with now what is supposed to be the exchange ratio. Should be what to what? 4:5. So we get 4:5. So we get the new shares to be issued. We compute new shares to be issued. We compute new shares to be issued. So when it comes to the new shares to be issued, we have seen the exchange ratio is that 4 shares. 4 shares is equivalent to 5 shares of the target. But the target, we know it has how many shares outstanding? So it has 2 million ordinary shares outstanding. So when you cross multiply, how many new shares are we going to issue? 1.6 million. So we get 1.6 million shares. So we are computing the post-acquisition. Earning per share of the predator. Earning per share of the predator. So it is supposed to be given by the combined earnings, we know from that formula. Then we divide by the number of the ordinary shares of the predator plus the new shares to be issued. So combined earnings, you simply add the net earnings for both. Chilulu, it is how much? That's it. The one for Rocker, it is 12 million. Then we divide by, so how many shares are there for Chilulu? Ordinary shares for Chilulu is 6 million plus the new shares to be issued, which you have calculated as 1.6 million. So now you compute so that we come up with what is meant to be the post-merger earning per share of the aggregator. $5.53. Yeah, so that should be our Roman letter 2. That is now meant to be the Roman letter 2. So after the Roman letter 2, we go to the Roman letter 3. We go to the Roman letter 3. So Roman letter 3, remember they were asking that using the results obtained in C, Roman letter 2 above, and assuming that Chilulu's limited price earning ratio would remain unchanged. So they wanted you to determine post-acquisition market price per share for Chilulu. So we remember from the concept of the price earning ratio. We remember the concept of the price earning ratio. So price earning ratio is remaining the same. The price earning ratio is remaining the same. So price earning ratio, it should be market price per share divided by the earning per share. So we are calculating for Chilulu. So before, what was the market price per share for Chilulu? It was how much? 50. Then you divide by the earning per share, which we got which value? It was 6. 5. It was 5. So when we divide, we are getting which value? We are getting a value of 10. Then now we are making the market price per share to be the subject. When you also make the market price per share to be the subject, it is simply the price earning ratio multiplied by earning per share. So we are looking for the post-merger. We are looking for the post-merger, post-acquisition market price per share. It will be given by the price earning ratio. Price earning ratio multiplied by earning per share. So price earning ratio we have just calculated because they say it will remain the same. Then this is what you calculated in the Roman letter. Remember the post-acquisition earning per share. We got which value? Sorry? 5.53. So that is basically what you are. So when you look at that question, the concept is just the same from the other questions we did yesterday. They are all narrowing down to the same items. So you just now review them and see how you can be able to go about their analysis. So you'll get 50 what? 55.3. So that is now all about the issue to do the mergers and acquisition. So you read the handout I gave you for the theory part. You go through the handout for the theory part. So now I want us to go to the restructuring and reorganization. We go to the restructuring and reorganization. We now go to the restructuring and reorganization. Restructuring and reorganization. We now go to the restructuring and reorganization. The restructuring and reorganization. So, you was there a handout here. Yeah. I gave you a small handout for restructuring and reorganization. Online, you confirm whether I gave you something on the restructuring and reorganization. How many people don't have? Yeah, so those who don't have, you request your colleague to resend them or reshare to you. Some are saying they have. Yeah, so in the class group, I had sent that handout. So when it comes to restructuring, it is simply part of mergers and acquisition. Merger is part of the restructuring. So they were simply saying that it is the process of the changing the capital structure of the company, and it is carried out as part of the corporate restructuring. Corporate restructuring is as a result of the changes in the capital structure, operations, changes in the core business activities, and the changes in the assets of the company, and the changes of the management team in order to improve the value of the company and to what? Enhance the shareholders' return. So any changes you do at a business in order to make sure that you are making profits or getting returns is what we shall be referring to as the one for them restructuring. So, so we can have a short break for the prayers. Then from there we come back. Then we go to the basic of that element of the restructuring. So you can have a short break from that.
It's a chance. Over the fifth.
So we can now check some few questions in your past papers in relation to that element of the restructuring. So first, I'm just referring to the theory question. So one of the theory question, I want you to check the pilot paper, December 2021. The pilot paper, December 2021, question number 4, part A. The pilot paper, December 2021, question number 4, part A. The pilot paper. So in that question, they have talked about unbundling is the process of selling off in non-core business to release the funds, to reduce gearing in order to allow management to concentrate on their core business, chosen core business. So in relation to the corporate restructuring under reorganization, they wanted you to briefly explain the following forms of unbundling. So those forms, when you go to that handout, they have been given to you on page 3 up to page 4. So Roman letter 1 is about management buyout. Roman letter 1 is about the management buyout. So when you go to page 3, when you check page 3 of the page 4 of the handout, you can see the management buyout. So this occurs when the executive managers of the business join the financing institutions in order to buy the business they are currently doing what? Managing. So managers may provide larger portfolio of the finances so that they have a majority shareholding. So it is also a process which takes place when the business unit or a subsidiary is sold to executive managers of the company. It is therefore a form of investment in the company by managers who acquire the shares of the company. That's now when it comes to management buyout. They finance part of the activities of the business and they are given the share. So they now become shareholders. That's now for the management buyout. So Roman letter 2 is management buy-in. So management buy-in, it is still on the same page 4. They are saying that it is where a group of managers outside the business acquire the business. So managers of another business, now they buy the business. They buy the business. So it takes place when a business is sold to a team of professionals outside the management team. It is therefore carried out by selling the company more efficient managers. This would be due to a weakness in the current management team. So that is now what we can be able to get from that level. Then Roman letter 3 is spin-off or demerger. Spin-off or demerger. It is still there on page 3. It is still there on page 3. So on page 3, you can see something about mergers and demerger. So a merger is where companies which are equally strong combine or come together in order to share a new business which will improve their financial position. But when they mention about the merger is where the company is now split into 2 or more separate business entities. So its aim is to create a new business entity which will enhance the value of the original company. That's now what we mean by demerger. Then I've also given you reasons for the demerger. I've also given the reasons for demerger. Then now I've also given you something down there about the spin-off. You can see the spin-off. Yeah, so this occurs when a subsidiary becomes an independent entity by the parent company, distributing its shares to its shareholders through the stock dividend. It is not likely to be used if the firm needs to finance growth, since no cash is generated. So that's now when it comes to the element of the spin-off. It is simply where a subsidiary of the parent company, it gives shares to its shareholders. So that's now when it comes to the spin-off. Then down there's also Roman letter 3. Sorry, Roman letter 4, sell-off or divestment. So sell-off, you continue on the next slide. So sell-off is also known as divestiture, is the sale of the company. It is done when the subsidiary does not fit into the parent company core strategy and the market may be undervaluing the combined business due to lack of the synergy between the parent and the subsidiary. So sell-off can also be used to raise cash, which can be used to pay debtors or debts or enhance expansion of the existing business. So sell-off just sells the subsidiary of the business. So that's now when it comes to the sell-off. Then the other one is divestment. So divestment is also given. Divestment is also given. You can see up there on page 3. Under the comparison, you can see be up there before the mergers or under the merger. So divestment is simply withdrawal of the investment in the business. So when we withdraw, that is now divestment. So I'm simply pointing them out for you to get time and read that handout. That handout, they normally give you some, when also you check now the real December 2021, you can see now the real December, the exam for December 2021, you also check question number 3. You now also check the question number 3. When you go through the question number 3 for December 2021, question 3, part A, question 3, part A, they have stated that different companies have varied aims and timings for undertaking corporate restructuring. So, however, single common objective in every restructuring exercise is to minimize the disadvantages and maximize what? On the advantages. So they wanted you to comment on the above statement, highlighting 5 reasons for undertaking the corporate restructuring. So you just give them any 5 reasons for restructuring. So I've given you something on page 1. You can see financial restructuring. Yeah, I've given you reasons for the financial restructuring. You can give them those reasons. Yeah, like now, one of them is to reduce debts of the company to the manageable level. The other one is to stabilize the company so that investors will do what? Will be able to inject new equity. Then to enable the company to concentrate its core business activities and operates effectively. Then to survive recession in the market, to avoid liquidation of the company. Also, those are some of the things we are to explain. But now when you go to part B, you can see part B, distinguish between the following terms in relation to the corporate restructuring and reorganization. Roman letter 1, the merger and what? The spin-off. Roman letter 2, management buyout and management buy-in. So read that small handout. Like now for that case, it is how many marks? 11 marks in your part A and part B. So you go through that small handout. It will be able to give you some details. So mine, I will only go to the side of the computation to see what we can get from there. So under that restructuring and reorganization, we can have a brief subtopic. We can now have a brief subtopic as valuation of securities and the business. Under the restructuring and the reorganization, we can have a brief subtopic as valuation of the securities and business. Valuation of the securities and business. The valuation of the securities and business. Valuation of the securities and the business. So first, let us also have a subtopic as valuation of the ordinary shares. We can also have a brief subtopic as valuation of the ordinary shares. As valuation of the ordinary shares. So when it comes to the valuation of the ordinary shares, we can simply summarize something brief by noting that ordinary shares are variable return securities. Ordinary shares are variable return securities. Variable return securities, which are classified into 2 as follows. Which are classified into 2 as follows. which are classified into two as follows. A will be constant dividend growth rate ordinary shares. A will be constant dividend growth rate ordinary shares. The constant dividend growth rate ordinary shares. Then B will be non-constant dividend growth rate ordinary shares. Non-constant dividend growth rate ordinary shares. Non-constant dividend growth rate ordinary shares. So let us start with valuation of the constant dividend growth rate ordinary shares. Valuation of the constant dividend growth rate ordinary shares. Valuation of the constant dividend growth rate ordinary shares. So under that, we shall summarize that the value of the security, is the present value. The value of the security is the present value, of all the expected future benefits. It is the present value of all the expected future benefits, that can be realized, from the security, Therefore, the theoretical value of the ordinary share, will be expressed as follows. Therefore, the theoretical value of the ordinary share will be expressed as follows. The theoretical value of the ordinary share will be expressed as follows. So to get the value of the share will be the same as PO will be given by DO in the brackets of 1 plus G. We divide by KE minus G. So to compute the price of the share, it is the same as PO in the brackets of KE. We divide by plus G. We divide by KE minus G. So this formula, you have some knowledge about it. When you are calculating the cost of the ordinary share, that was KE. So you make PO to be the subject, whereby that DO, when you increase it by the growth rate, it will definitely be D1 divided by KE minus G. So our DO is the last dividend that was paid. Then G is the constant growth rate. Then D1 is the next dividend to be paid. Then you remember KE is the cost of the ordinary share. KE is the cost of the ordinary share. So we shall be using that formula on how to get the value of the ordinary share. So that's now A, the one for the constant dividend growth rate ordinary share. Then we can also go to B, non-constant dividend growth rate ordinary share. Non-constant dividend growth rate ordinary share. The one for the non-constant dividend growth rate ordinary share. The non-constant dividend growth rate ordinary share. So for that, we summarize that the value of the ordinary share, in this case will be expressed as, the value of the ordinary share in this case will be expressed as follows. The value of the ordinary share in this case will be expressed as follows. So now to get the value of the share, will be equal to present value of the future benefits during non-constant period. Then we add present value of the future benefits during the constant period. Like that. So you simply add present value of the future benefits during the non-constant period. You add present value of the future benefits during the constant period. So we shall be understanding them when we do some questions in relation to that. So after summarizing that, let us also write something brief about impact of the financial restructuring. We can write something brief about the impact of the financial restructuring. What could be the impact of the financial restructuring? Impact of the financial restructuring. So when it comes to the impact of the financial restructuring, we can write that the impact of the change in the capital structure, the impact of the change in the capital structure, the impact of the change in the capital structure as a result of the financial reconstruction, can be determined by A will be change in the growth rate. A will be the change in the growth rate. A will be change in the growth rate. B will be change in the share price. So B is supposed to be change in the share price. Then C will be change in the risk. C will be change in the risk. So we can start with A, change in the growth rate. Change in the growth rate. The change in the growth rate. So when it comes to the change in the growth rate, we summarize that this is determined by computing the growth rate. It is determined by computing the growth rate in order to assess the performance of the company. In order to assess the performance of the company. In order to assess the performance of the company. Order to assess the performance of the company. So I will go direct to a question on that to see how we can check the growth rate, then also use it to get the value of the firm. So our first question, I want us to check. The first question I want us to go through, it should be, I want you to check November 2018. November 2018, question number 3, part A. We go to November 2018. Question number 3, part A. So let us check November 2018. Question number 3, part A. Check November 2018. Question number 3, part A. So that question 3, part A, they were asking that the following are the summarized financial statements. The following are the summarized financial statements as at 31st December 2015 to 31st December 2017. So they gave you 2015, 16 up to 17. So turnover is given. Operating profit, interest, profit before the tax. There is also taxation. Then profit after tax. They have also given you the proposed dividends. Also the retained what? Profit. So statement of the financial position as at 31st December 2017 has also been given. So you can see non-current assets, current assets, financed by ordinary share capital, reserves, 10% long-term debentures, and also short-term debts. Also the short-term debts. Then additional information, note number 1. They have said that the stock market analysts expect post-tax earnings and the dividends to grow at a rate of 25% per annum for the next 3 years. Thereafter, annual growth rate will revert to the company's growth rate and remain constant in each year to what? To perpetuity. Note number 2, the overall beta is 0.8 and the beta of equity is 0.75. Note number 3, risk-free rate of return is 12%, then market rate of return is 28%. Then note number 5, the current market price of the ordinary share is 67.7, which is cum dividend. So cum dividend means it has included dividend. We normally use the one which is ex dividend. That means you subtract dividend from it to get the value which is meant to be ex dividend. Then the debenture price is 89.5, which is ex interest. Corporate tax rate is given as what? 30%. So now required from letter 1. Evaluate whether the share is currently overvalued or undervalued by the market forces. Then you advise the investor whether to do what? To buy the ordinary share. So the concept is in the note number 1, where they have said that the stock market analysts expect that the earnings and the dividend to grow at a rate of what percent? 25% per annum for the next 3 years. Then thereafter, the annual growth rate will revert to the company's growth rate and remain constant each year to perpetuity. So the first 3 years, that is during the non-constant, because it is increasing at 25%. But thereafter, it just remains. So that's now during the constant. So to get the value of that share, we shall be getting the present value of the future benefits during the non-constant. Then we also add the present value for the future benefits during the constant. So one challenge is that note number 1. You see that thereafter annual growth rate will revert to what? The company's growth rate and remain constant each year to perpetuate. It has not been given. So you need to calculate that. So when we are dealing with the cost of capital, I gave you 2 methods of how to get the constant growth rate. Compounding method and retention ratio method. So for this one, you would apply the compounding method. We use the compounding method in order to come up with the constant growth rate. So for us to calculate the constant growth rate, to compute the constant growth rate. So constant growth rate is supposed to be given by compounding method. So G will be given by N, Dn divided by Do minus 1. So that's now the compounding method on how we can calculate the constant growth rate, how we can be able to compute. So you can see in the income statement for the year ended 31st December, there is 20 15, 2016, and what? 2017. So the dividend in the year 2015 will be DO. Remember how we are labeling them? 2015 will be DO. 2016 will be D1, isn't it? 2017 will be D2. So as per that arrangement, N will be 2. So now that tumepewa 2015, 2016, and 17. But the first one is normally period 0. The first one is normally period 0. So that means that to get our G, N will be 2. Then D2 divided by DO, then we minus 1. Then we minus 1 in that order. So our N will be 2. So that will be D2 is now our DN. So this one is 0, sorry, not 1. D 0, DO. So we express it in that manner. So dividend per share was not given. What they gave you is simply the proposed dividends. Are you able to see in that income statement the proposed dividends? Yes. Yeah, so we need to get the dividend per share. We need to get the dividend per share by checking under the financed by. So under the financed by, they gave you ordinary share capital. The bar value is 20. Total amount is how much? 30 million. So to compute the number of the ordinary shares, number of the ordinary shares. Number of the ordinary shares will be equal to 30 millions. We get 30 millions. You can see the bar value is what? 20. So you take the 30 million divided by 20 so that we come up with what is supposed to be the number of the ordinary shares. There are how many ordinary shares? So it will be 1.5 millions. So our D2 is the dividend per share in the year 2017. Our D2 is our dividend per share in the year 2017. So go to the income statement. Are you able to see the proposed dividends for the year 2017? There are 3 millions because there are 3 zeros at the top. So take the 3 millions, divide by the number of the ordinary shares, which are 1.5 millions. Which are 1.5 millions. We have just calculated the 1.5 million as the number of the ordinary share. So dividend proposed were 3 millions. They have given you 3 zeros at the top. So we divide to give us now the dividend per share. It will give us 2. We also calculate DO. DO is the dividend per share in the year 2015. DO is the dividend per share in the year 2015. So it will be given by 2.1 millions. 2.1 millions, also divide by 1.5 million ordinary shares. We also divide by 1.5 million ordinary shares. So that will give us which figure? 1.4. We get a figure of 1.4. So after that, now we go back to our equation. We calculate our G. We now compute our G. So G should now be equal to 2. So that will be 2 divided by 1.4. So our dividend per share in the year 2017 is 2. Our dividend per share in the year 2015 is 1.4. So now N is also 2. Then we can now get G from that level. 7. When you express it as a percentage, you multiply by 100. Online, you give me the figure. Your formula to metumia mara mingi, isn't it? You have used it for so many times. Online, you give me the figure so that I can know whether we are together. When you express it as a percentage, non 19.5. Anyone else? Yeah. Online on an pair 19.5. Are we getting 19.5? Yeah, we are saying it is 19.5. So after we have calculated the growth rate, after we have computed the growth rate, we also need to get the cost of equity. We also need to calculate the cost of equity. We also need to get the cost of capital, or simply, so cost of capital will be given by, so cost of capital, which is KE. So it is given by Capel. The cost of capital will be given by Capel, which is risk-free rate plus expected return for the market minus the risk-free rate multiplied by the beta factor for equity multiplied by the beta factor of equity. So note number. When you check the note number 3, what are you given as the risk-free rate of return? So this one will be 12. Expected return for the market in the note number 4. They gave you 28. We also subtract 12. So what do you have there as the beta factor for equity in the note number 2? The beta of equity is 0.75. 0.75. So that will give us the cost of capital, to be able to give you the cost of capital. So it gives us 24%. Yeah, so once we have now those details, we get the present value of the future benefits during the non-constant. So now we compute present value of the future benefits. Present value of the future benefits of the future benefits during the non-constant period. During the non-constant period. During the non-constant period. So we now compute the present value of the future benefits during the non-constant period. So we shall be having the year, then dividend per share. So present value of the future, present value interest factor. So cost of capital is what you have just calculated. You are saying it is 24%. That is our discount rate. Then we get the present value for that. Get the present value for that. So we start off with year 1. So year 1 would be 2018. Year 1 is meant to be 2018. 80. So we have 20, 15, 16, and 17, isn't it? That is the past. It was the income statement. Income statement is normally for the year ended. 31st December 2017. So now year one will be 2018. So we go to the note number 1, where they have said that the stock market analysts expect that the post-tax earnings and the dividends to grow at a rate of what percent? 25% per annum for the next 3 years. So to get the dividend for year 1, which is now 2018, you take the dividend for 2017. Report how much per share? We calculate it. We got 2. So remember the dividend per share for 2017. So that figure, we are increasing it by 25%. When you increase it by 25%, the same as 1 plus 0.25. We increased it by 25%. So that we get the dividend per share for year 1. When you increase the 2 shillings by 25%, so we multiply by 1.25, so that we get the value for year 1. So how much is it for year 1? It's 20. 2.5. Also year 2, you take 2.5, you also increase it by 25%. So it will be which year? Sorry? 3.125. When it comes to year 3, also 3.125 and 1 plus 0.25, which is supposed to give us which? Sorry? 3.906. Yeah, so I want us now to go to the table, the present value table. What is 24% in year 1? We check in the first table. Check through first table. Year 1 is 0.806. How about year 2? 694. Then 0.5787. So I want you to multiply these figures by these figures. You get your present value. Then you add them together. Are they correct?
Second.
The second one is 6904. 6. Like that. How about the third one? 0.54. 52. Like that. Are those the figures from the table? We are using the first table. Yeah. Online, are you able to see those figures from the table? The present value tables. Yeah.
Can we agree to go to this process around the answer?
The final answer can have it into 2
The present value.
So that is now during the non-constant period. That will be during the non-constant period. So it is coming to around which year?
6.097.
So that should be during the non-constant. So when you go back to the note number 1, when you go back to the note number 1, they then said that thereafter annual growth rate will revert to the company's growth rate and remain constant each year to perpetuity. So that will be present value of the future benefits of the future benefits during the constant period. During constant period. Constant. That should give you present value of the future benefits during constant period. So when it is constant period, it was PO should be equal to PO in the brackets of 1 plus G divided by KE minus R. So when it is during the constant period, the formula is that our PO should be equal to DO in the brackets of 1 plus G divided by KE minus what? G. So our last dividend we calculated was year 3, isn't it? So the next one will be year 4. So that means our DO will be the dividend in year 3. That's dividend. Because we are now thereafter. Thereafter, year 0 is year 3. Which also means that our PO is also in which year? In year 3. Because all of them are DO and PO. So that will be dividend in year 3. And this price is also in year 3, but we require it in year 0. We require it in year 0. So to get that figure in year 0, discount them at the present value interest factor, 24% in year 3, 24% in year 3, because we are converting it to year 0, but it is in year 3. So we convert it by discounting it at 24% in year 3 in order to go to 0. So our DO is the dividend in year 3, which was 3.906, which is our 3.906. The growth rate is the historical that we calculated. You remember 19.5%? Was it 19.5? Yeah, so 19.5, it is now the same as 1 plus 0.195. Then we divide by KE. KE is the 24%, the cost of capital. Remember our KE was 24%, which is the same as 0.24 subtract 0.195. Then you are supposed to multiply by 24% in year 3. 24% in year 3, you remember it is 0.5245. So unakumbuka hii the 24% in year 3. Yes. So multiplied by 0.5245, so that you now get the value of that share during the constant period. During the constant period. 54.4. So now we add them together during the non-constant and during the constant to get the value of the share. So to come up with the value of the share. So to get the value of the share, so value of the share will be present value of the future benefit during the non-constant. You said it was
0.097.
0.977 like that.
Yes.
Then he inatupea ngapi?
4.404.
Sorry?
404.
404. So when you add them together, they end up giving us which value? Sorry? 60.501. So that is now our value of the share. That now should be the value of that particular share. It was meant to be the value for the share. So they were asking you to state whether it is currently overvalued or undervalued. So we compare that with the current market price. We compare that with the current market price. So current market price was given to you in the note number 5. It was 67.7. But that one is come dividend, isn't it? I said we require X dividend. You subtract dividend, which we calculated for the year 2017. Remember, it was 2 shillings. We will subtract the dividend for the year 2017, which was 2 shillings. So we end up having how much? It's 65.7. Yeah, so the market, the share is going at 65.7. But the true value of the share is what? 60. So this share is overvalued by the market. So the comment there is that the share is overvalued by the market forces. 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 So the market is selling at 65.7. But the true value when you calculate it is 60. So it has been overvalued by the market. Then, now the Roma letter 2, they were asked to advise whether to buy the share. So you should not buy, because in the stock market, it is selling at 65. But the true value is 60. So the investor should not buy the share. The Roma letter 2, we are advising the Roma letter 2. The investor should not buy the share. Should not buy the share. He should not buy the share because because it will lead to a capital loss. It will lead to a capital loss. Should not buy the share as it will lead to the capital loss. Yeah. So that was now the Roman letter 2. If you buy, the share is actually overvalued. So you end up getting a loss. So that is now in relation to that question. So the next question we shall be looking at when we meet in the next class. Remember, we shall go to the question for May 2019. May 2019, question 5, part B. May 2019, question 5, part B. So when we meet, we shall look at May 2019, question 5, part B. So in our next class, we should be able to finish this topic. in our next class, we should be able to finish this particular topic. So there is also some other notes I've sent to the class group. After we finish this, we shall now go to this next one. So we can stop there. Online, you check in the class group. There are some notes that were sent about the financial distress. So get those notes. In our next class, we shall finish this part and we start on that one.